Welcome, and thank you for joining us. You're listening to The Educated Investor. On this podcast, we'll not only cover current events, but also ideas to help you possibly maximize your Social Security benefit, manage your taxes, and overall become a more educated investor. And now, here's your host, Jerry Blakely.
Well, hi, everybody, and thanks for joining me today on this special broadcast of Householder Group's The Educated Investor podcast. This is your host, Jerry Blakely, and today I'll be walking you through the top 5 Secure Act 2.0 changes that will affect most retirees. Now, we felt it might be important to give you a little bit of my background just to kind of provide a little color and feeling to this quarter's podcast. So I'm a certified financial planner, and I was a licensed financial advisor for 38 years, 23 of those years at Householder Group. I sold my financial advisory practice back to Householder Group just a couple of years ago, but since I don't play golf and I don't fish, I'm still very involved in the industry of being a master elite member of Ed Slott's Elite IRA Advisory Group, and I acting as a trainer, coaching and consulting with Householder Group's advisors to help them deliver high-level, top-notch, proactive tax planning for our clients. Proactive planning in various areas. Now, proactive planning, that's where we want you, our clients, to know what you can do to protect your investments, reduce your taxes, and prepare for passing your estate. What you can do, not what you should have done, but what you can do now before you get there and miss the timing deadlines on the action steps and planning concepts and opportunities to do better. So even though I don't interact directly with clients anymore, I have a passion for sharing with others some of the things I've learned along the way over my years, like this saying, one of my favorites. It doesn't matter how much you have there on paper, your balance sheet. It's what you get to keep that counts after taxes. It's what you get to keep after taxes that counts. So with that in mind, let's jump in. I'll be walking you through the top 5 Secure Act 2.0 changes that will affect most retirees. Now, as you may already be aware, a major tax law called Setting Every Community Up for Retirement Enhancement Act, or the acronym Secure Act for short, was passed late December 2019, and that became law January 1st, 2020. And then came Secure Act 2.0, like version 2, which became law January 1st, just a few months ago, 2023. And this new Secure Act 2.0 legislation has over 4,000 pages in it and contains over 90 changes for long-term retirement savings, and has financial impacts for Americans at every age. So there's a lot there. But for today's discussion, I'm going to cover the top 5 changes, I think, that are the top 5 changes that impact most all retirees, or at least most all who have managed to save up money in retirement plans like IRAs and Roth IRAs and 401ks and the other workplace retirement plans like 403bs and 457s and so forth. So that's what we'll be covering. And I'm going to go, on kind of classroom style here, and I'll be talking about these 5 things. If you are able to, grab a piece of paper and a pencil if you want to, because some of the stuff gets technical. Grab your latte and your favorite tea or a glass of wine, whatever. Don't drink too much wine. You might fall asleep in the middle of this thing. But I'm going to go through kind of quickly these 5 areas. And by the way, there'll be an outline sheet that I will tell you how you can get it in your hands if you don't take good notes, that you can have the outline sheet to kind of remind you, because some of the stuff I'm talking about may be important and impact you in your particular situation. So you ready? Let's get going. Item number 1 of the top 5 Secure Act 2.0 changes would be the RMD age has changed to 73. Now, if you don't know RMD, this is one of the big deals about retirement plans, is required minimum distribution. And the deal, if you don't know the IRS rules, is that when you hit a certain age, you got to start taking money out by that age. And there's a minimum amount. If you don't take at least the minimum amount and they catch you, which they have little ways the IRS can catch you, there's going to be a penalty. And the age was 70 and a half. A few years ago, it changed to 72. And now Secure Act 2.0 says it's 73. So you don't have to take any money out required, to avoid the penalty until you hit age 73. And that new rule is effective this year. Now, the funny thing is this move to make it later and later so that you have more money left in your account because we're living longer and longer. The Secure Act 2.0 says that 10 years from now, 2033, the age is going to jump to 75. You won't have to take money out till 75. Obviously, if you're listening to this and you're over 73 already, you don't care. But if you're coming up to 73, you got to start taking it out pretty soon here at age 73. And for someone much younger than that, it's going to be 10 years from now. When you hit 75, you have to start taking the money out. By the way, the penalty got adjusted from 50%. If you don't take out what you should have took out, a 50% penalty when they catch you, it's been reduced to 25%. So that's top change number one, is the RMD age while you're living. When you hit that birthday, you got to start taking money out. Number two of the top five most important Secure Act things is, I call it the Rothification. The Rothification of retirement accounts. And if you don't know, a Roth account versus a traditional account like a Roth IRA or a Roth 401k, a Roth account is money that the money went into the account already. You paid taxes on it already. You don't get a tax break putting money in, but it grows tax-free, and you can take all of it out later, absolutely tax-free. And the IRS prefers everything to Roth. So they're Rothifying everything. We made up that word here, Rothification. It's not an official IRS word, but Roth is a Roth account. And there are many different start date details and stipulations that apply that I'm not going to go into all these details, but I'm going to tell you a few things about what the IRS is saying about, we'd like you to do a Roth account. By the way, why the IRS would like you to do a Roth account, they're giving you a big tax break. You can build up a bunch of money, and later on, there will be no requirement to take the money out if you have it in a Roth account. And when you do take it out, it's all tax-free. It's a great tax break. Why is the IRS doing that? I'm from the IRS, and I'm here to help you, right? So we know the joke. But the reason is because to get money in the Roth account, you got to pay tax on the money before it goes in the account. You don't get the tax break now, you get it later. And that's one reason the IRS is doing it, because they're bringing in tax revenue. So by doing this Rothification concept, they're bringing in more tax revenue now. And then they kicking the can down the road in terms of, what do we do later when there's no taxes being paid on this? So I can't comment on that later. I don't know, but we do know right now this Rothification thing is happening. So some of the details on this thing is that we've had this Roth account for 20 years now. A Senator Roth guy, I forgot his first name, but a Senator Roth 20 years ago made up this a tax-free IRA account, where later you pull the money out with no taxes. It's tax-free later. We've had that for 20 years. And then just recently, I don't know, last 3, 4, 5 years, the IRS said, now we can do not just Roth IRAs, we can do Roth 401k. So if your 401k where you work allows a Roth component in the 401k, you can build up this tax-free account in the 401k if your plan allows it. So Secure Act 2.0 said now Roth accounts are allowed in SEP and Simple plans. And if you have no idea what a SEP and Simple plan is, because you're probably not self-employed. So those are self-employed pensions and something, I forgot what Simple stands for, but it's for self-employed people. If you're self-employed and you want to find out more about the SEP and Simple, you're going to be talking to a financial advisor. We'll tell you how you can connect with a householder group financial advisor to figure out some of those details toward the end of our podcast today. But another detail that Secure 2.0 did is that Roth accounts now, the employer match and non-elected contributions are allowed in workplace plans, meaning, how you put money in the 401k off your paycheck and then the employer is going to match you. Well, you can now do that. The matching part from the employer can go into a Roth account in your 401k at work. That's pretty cool. Here's a big one on the Rothification is any unused 529 plans. Those were the college tuition saving plans. you put the money away for your child or somebody younger, and as time goes on, maybe there's money in there you don't need to use for college. If you used it for college, you get a big tax break on the tax deferred growth and everything. But now Secure 2.0 says if you have money in the 529 plan and you don't want to use it for college, you can convert it to a Roth account. Again, there's some stipulations, there's limitations and so forth, time frames, but that's pretty cool. 529 plans can now be converted to a Roth account if you follow some of the detailed stipulations and rules that apply with that. Now, here's another big one that only hits certain people, but it's a big one on this Rothification concept. And that is that while you're alive and you have money in a 401k, you remember I said the required minimum distribution, if you hit a certain age, you have to take money out of your 401k. Except there's a rule that said if you're still working at the 401k, you don't have to take any money out. There's no required distribution from a 401k, even if you're of the age, 73 or older, if you're still working at that 401k. So the new Secure 2.0 Rothification thing changed a little tweak. They tweaked a little bit of the detail here that said prior to Secure 2.0, if you have a Roth 401k, you still had to take money out of the Roth because you were age 73 or older. Now they said, no, you don't have to. So let's make it simple here. Any money in a 401k, if you're still working for that employer and you're of age, 73 or older, you don't got to take any money out. There's no required minimum distribution on the 401ks, including a Roth 401k. Then here's a big one that if you're going to do the catch-up, where I think it's over age 50, you can put extra money away beyond the normal limits. On the 401k catch-up, any catch-up money must go to a Roth 401k if your wages exceeded $145,000 in a year, and that number will be indexed for inflation. So this is the big deal. What the IRS is saying, in certain circumstances, we would encourage or require people to put money away for their future retirement into Roth accounts, which accomplishes those two things. They get more money. The IRS gets more tax revenue now, because you have after-tax money going into a Roth, and you get tax-free money later by pulling money out of a Roth account, 401k or Roth IRA, completely tax-free later on. So it's very, very good stuff. Okay, number three. Here's the top number three of the top 5 things that Secure 2.0 has changed. The concept here is the qualified charitable distribution, QCD, qualified charitable distribution, is now $100,000 per person maximum, and that's indexed for inflation. Let me explain what this QCD is. I don't know if you're aware of this, but you could actually have, if you're over 70 and a half years old, the tie back to the age that said you had to start taking required distributions at age 70 and a half. They didn't change the 70 and a half here on the QCD. It's still 70 and a half. And it says you can have the IRA custodian. You can't do this from a 401k, but from an IRA you can. You can tell, whoever's holding the IRA, whether it's going to be LPL or some other kind of IRA, Bank of America, IRA custodian, whoever has the IRA account, you can have them write a check to distribute money directly to a charity. So you have the check cut to First ABC Church of the Valley or something, whatever the name of your charity is. And if you do that, the money comes out of the IRA. It goes right to the charity. You can hand them the check if you want. That's okay. But that bypasses your tax return. So there's no income showing up on your tax return. There's also no deduction because you're not going to deduct it because you never got the money in your hands right away. Now, this is very important because it's up to $100,000 per person per year. You can move from your IRA account to a charity and have it completely bypass your tax return. This is especially helpful for those people who are making charitable contributions, but they're using itemized deductions. They're not using itemized deductions. They're not using Schedule A. And why would you do that? Because the standard deductions are so high. This is getting technical, I warned you. But if you are charitably inclined and you have money in an IRA, you should be talking to your financial advisor about what is this QCD thing? How's it work? And is that something that is right for me? And if it is, how do we do it? Because it's going to lower your taxes by doing this QCD concept. And more importantly, it lowers your adjusted gross income, AGI is the acronym, adjusted gross income. If you lower your adjusted gross income, you can lower the taxes on your Social Security income, because Social Security income might be none of it is taxed. The whole Social Security could be 0%, none of it's taxed, or only half of it's taxed, or with large income situations for people who have large incomes, 85% of your social can get taxed. But imagine that, moving it from 85% down to 50, or maybe down to 0, because you were able to lower your adjusted gross income. How do I lower my adjusted gross income? Well, one thing is, if you're giving to charity and you're over 70.5, do the QCD, and it's going to lower your adjusted gross income. Lowering your adjusted gross income can also get rid of this extra 3.8% tax on dividends and capital gains. The IRS calls it net investment income tax, and I call it NIT, N-I-I-T, and it's an extra 3.8. You may know this, you may not, but if you have dividends or capital gains, depending on if they're long or short, how long you held it, and so forth, the tax on that is a special kind of tax. It's either 0% tax, 15% tax, or 20% tax. But if you have too much money on your tax return, the adjusted gross income is too high, there's an extra 3.8. So if you're technically inclined and you're thinking, I've got a capital gain, it's only 20%. No, it might be 23.8% because of this NIT tax. So that could be reduced or gone away with because you lowered your adjusted gross income by having the IRA custodian write the check right to your charity, and you give the check to the charity. Also, here's a big one about this charitable deduction, and that is your Medicare premiums. Your Medicare premiums are adjusted up or down according to how large your adjusted gross income is. You want to get this money off your tax return. Don't take money out of your IRA accounts, put it in your checkbook, and then turn around and write a check to give it to the charity. Have the IRA custodian write the check to the charity, and it's going to lower your tax return. I don't know if you know the Medicare premium situation. This is kind of weird and technical, but those of you who are listening that are on Medicare, you might be aware that every November you get this letter from Social Security and Medicare. I forgot who sends it, they kind of both combined, but it's called the IRMA letter. And it says right on it, that acronym, IRMAA. It stands for Income Related Monthly Adjustment Amount. The IRMA letter comes each November, and it says, based upon the last tax return we just saw, we're going to adjust your Medicare premium starting in January. And you may know this, you may not, but you could pay as little as $160 something a month, 164 point something. I forgot exactly the numbers. The number changes a little bit. Actually, it went down this year, but 160 something a month per person for Medicare premium, or as high as $560 a month, because you have too much money on your tax return, too large an adjusted gross income. So this is a big deal. Pay attention to the IRMA letter. Your accountant never sees the IRMA letter. Nobody sees it but you and Medicare and Social Security, unless you bring it to your meetings with your advisor. And I think you should. If you get an IRMA letter every November, bring that to your advisor and discuss it, because you have some direct control over what your tax return looks like by distributing money from your IRAs and the capital gains and dividends. Your financial advisor can help you proactively kind of customize your tax return in certain circumstances and lower your taxes. Okay, number 4 of the top 5. I hope you're still with me. Got your pencil lead all sharpened up. Sip on that latte and your wine. And let's do number 4 now. This is number 4 of the top 5 changes about Secure Act 2.0, dramatically changing the rules on retirement plan taxation and distributions. It's the QLAC, QLAC, which stands for Qualified Longevity Annuity Contract. A qualified longevity annuity contract. A QLAC delays retirement distributions, the required distributions, until age 85. Now, you remember I just got through saying it moved from 70 the required minimum distribution to avoid the penalty. You didn't take the money out, the minimum out. It used to be age 70.5. It moved to 72. Now it's 73. It's going to be 75 in 10 years. The QLAC, if you can move money from an IRA to a QLAC, and you can in the certain circumstances, you don't have to start taking the money out of the QLAC until age 85. Now, what's the big deal? Well, it's not a big deal if you need the cash flow. Like, no, I don't want to do that because I need the money to live on. So I'm not talking about that situation. I'm talking about somebody who says, I got all this money built up in my 401ks and IRAs on the traditional side, the pre-tax, and now they're making me take money out and I got to pay tax on it. I don't even need the money. So those people, like, you want to delay that distribution. You want to get the money off your tax return, do the QCD, the qualified charitable distribution, and maybe do a QLAC. Take a chunk of IRA money and move it to a QLAC, and you don't have to start taking the money from the QLAC until you're age 85. So that's not a new thing with Secure 2.0. What Secure 2.0 did is they said that now it's $200,000 per person, lifetime max, you can put into a QLAC. It was 130. So 200,000 moved to a QLAC would remove roughly about $8,000 from your tax return, the required distribution on that. If you're married, it's 400,000 between the spouses, him and her, if that's the case. So the other thing is there was a 25% of the IRA limitation. Like you could only move, let's say 130, the old number, 200, the new number, unless the IRA you're moving it from wasn't very big. You could only take 25% of the IRA. They repealed that. So there's no limit at all on moving money from an IRA to a QLAC, except 200,000 per person per lifetime. Now, to do this, understand that this is why it's important to work with a good, knowledgeable financial advisor to understand some of these things, because you got to move the money from the IRA to the QLAC if you're doing it as a tax-free transfer. So you got to do the paperwork correctly. You don't get a check in your hand and then try to put it in the QLAC. You can't do that. You have to move it by doing the right paperwork, tax-free from an IRA. You can't do it from a 401k. It has to come from an IRA directly to a QLAC. And if you do that, you're turning that IRA, that QLAC, you're turning the money that came from the IRA, you put it in the QLAC, you're turning it into a guaranteed income stream. If you live too long, the joke's on them. They have to the QLAC instrument is going to keep paying you, even if the money is all paid out to you. You've lived so long. It's a guaranteed income stream you cannot outlive, and it doesn't have to start coming to you until age 85. Now, this QLAC is not really an investment account. Like if you say, I put it in a QLAC, am I going to choose stocks or bonds? Or, you can't, that's not what it is. It's very much like buying a delayed single premium immediate annuity. If you don't, SPIA, if you don't know what that is, it's like you put money in the account and you can't really get the balance back in your hand unless you passed away. And, you don't get it. Your beneficiaries get it. But what you're doing is moving money into a guaranteed income stream that you don't have to start till age 85. It will be taxable when the income starts, but you don't have to pay the taxes till you're 85 years old. It's a way to delay the taxes and give you guaranteed money that if you do live a long time, can run out of cash flow because you have this, QLAC there waiting for you. It's never fun if you're still here and your money's not because you live too long. So not a bad idea to get this guaranteed lifetime income for later in life and reduce your taxes in the meantime. Item number 5 of the top 5 things that Secure Act 2.0, the top 5 changes from Secure Act 2.0. Remember, there's like 90 changes. I'm only talking about 5 categories of changes, even though I'm giving you some of the details along the way. Number 5 is penalty relief. The penalty for you did something wrong and you got to pay a penalty. And this has to do with, like I mentioned, the RMD, like, okay, happy birthday, you're age 73, you got to start taking money out, and nobody told you, like you didn't realize it, you didn't read the IRA custodian letters, your accountant never mentions that stuff, they just do your tax return, your advisor wasn't aware, didn't tell you, like, happy birthday, you got to start taking money out. If you miss the RMD, it was a 50% penalty, now it's only 25% penalty. So that is good in terms of less penalty. Now, the other penalty here I want to talk about that's a big deal that Secure Act 2.0 changed was the 10% early penalty. And it says, like, if you take money out of a 401k or an IRA and you had to be old enough, and that age was 59 and a half, Okay, that's still there, by the way. The older than 59 and a half, exemption is still there. Like, no, you're over 59 and a half, you can take the money out, got to pay tax on it, but there's no 10% penalty. The 10% penalty was if you were too young. If you're under 59 and a half, now that's still there except for these exceptions now. So what they did was they expanded the exceptions to the 10% penalty. So I got 4 of them to tell you about. Here's the first one. Private sector firefighters and state and local correction workers are now included in the 10% penalty down to age 50, not 59 and a half. So that age 50 thing was there, but now it's like private sector firefighters. I had a client one time when I was a financial advisor. He worked at a local airport on the firefighting crew, like a private airport, and if the planes landed and caught on fire, he'd go out and put the fire out. But he wasn't a government employee. He was a private airport firefighter company worker. And he was a private sector firefighter. He would be included if he had money in a 401k or an IRA. And if he wants to take the money out and spend it, got to pay tax. But if he wasn't old enough, which was age 50 now, there would be a 10% penalty. Age 50 and over, no penalty. And Secure Act 2.0 said, or not just the age thing, you could be younger than 50, but have 25 years of service working in that area, in that private sector firefighter or state and local corrections officer, like at the local incarceration facility, a prison guard or something like that. So 25 years of service, because some of those guys let's pretend they started age 22 or something. So 25 years would make them 47 years old, 25 years. They can take the money and run, not pay the penalty now, the 10% early penalty. That's a lot better than age 59 and a half or 50. 25 years of service might come in very handy for that particular niche of workers. Okay, another one to avoid the 10% early penalty is terminal illness. If you got terminal illness and you can document it, you can take the money out of a 401k or IRA, pay the tax on it, but there is no 10% penalty for being too young, and there's no maximum amount you can pull out. Take out the full $1 million, and if it's terminal illness, go on your last hoorah to Tahiti or Hawaii or something and spend the money. And there's no penalty on it, which is the cool thing. 10% early penalty is accepted, exemption for that if you have terminal illness. Another one is emergency expenses. Now it says for IRAs, you could pull out $1,000 per year and say it's for an emergency, or from your workplace plan, $2,500 per year. You got to pay tax on it, but you can take it and spend it and not have the penalty, regardless of how old you were, no 10% penalty. That's one that's going to not take effect in 2023 because they're trying to figure out the details and all that, and have the custodians and the 401k plans and the IRA custodians figure out how to technically handle that. So that's going to start next year, but that's part of Secure 2.0. And then here's another one is domestic abuse. So if the reason you're pulling money out is you had a domestic abuse situation, $10,000 can come out of your plan, your workplace plan or your IRA, and you got to pay tax on it, but there's no 10% penalty because you were too young, which is supposed to be age 59 and a half. You took the money out to spend it, and the reason you're spending it, even though you're too young, you got a domestic abuse situation, no 10% penalty. And that number is indexed for inflation. So that means every year that 10% is going to go up if consumer price index went up, inflation went up. So I hope some of this stuff made sense to you. I know it's technical. I went pretty quick. Well, thank God that I'm not going to cover all 90 changes. I don't even know all 90 changes, but I know a lot of them. And there's a lot more to talk about that I didn't even talk about today, just for time's sakes. And I don't know. That's about all I'm going to cover. There's still a lot more. And I don't know about you, but I know I'm about out of brain cells right now anyway. So there's a lot there. So here's a couple of ways to help with that. There's more information if you want to find out more about it and some of the details of what I talked about. If you'd like to get a brief outline of what was discussed today, I mentioned earlier at the beginning of our podcast, there's several ways you can get this outline document in your hands. So like I took notes for you before we did the podcast, and we have that available to you as an outline. So one way is you can visit the Householder Group website. It's at www.householdergroup.com. Normal spelling, no spaces, householdergroup.com. And under the About tab, you would click on HG Podcasts, and there will be available, say, give me the outline if you go to the website. Again, it's the householdergroup.com website. Go under About tab and then click on HG Podcast. Another thing you can do is just regular email. You can email to educatedinvestor@householdergroup.com and say, give me that Secure Act outline with the 5 top things, educatedinvestor@householdergroup.com. That's the email address. Or better yet, call your own local Householder Group financial advisor's office and ask them for a copy of it, because they'll have the outline there available to give you at your own local Householder Group financial advisor's office, which you can find. Google search if you're not a client already of a Householder Group financial advisor, because if you are, obviously you know how to get a hold of that advisor. But if you're not, you want to just do some Google search, find one close to you, and call that office and ask them for a copy of it. Oh, the other way here, if you received an email from Householder Group, from your advisor for this podcast, there's a link there that you can download the outline also. So if you got an email inviting you to the podcast, you'll find a link on that email that says, hey, I want to download the outline to the podcast. All right. Well, when you reach out one way or the other and you get a copy of the outline of today's discussion, I'd like to invite you to arrange for a complimentary face-to-face or virtual, digital Zoom call thing, assessment and review of how your financial plans may be impacted by the tax law changes that came from Secure Act 2.0. How about finding out with a review and assessment? And that's complimentary. We're offering that. And some people always ask, how much is the complimentary consultation? No, the complimentary consultation is complimentary. There'll be no charge for it. Our advisors always take the same kind of approach or mantra, that we're not going to do anything for you that we expect to get compensated on unless we've agreed up front. So there's no such thing as an unexpected bill sent to your mailbox, that kind of thing. So it's complimentary. And when you do reach out to get the outline, how about trying to schedule that assessment and review, the complimentary? All of our Householder group of financial advisors are fiduciaries. They're licensed, credentialed, and experienced to deliver financial advice that is independent. We don't have to do certain kind of products or anything. We're independent completely. We're holistic. That is, that we're coordinating your investment plans with proactive tax planning and proactive estate planning, like we talked about today. So we're independent, holistic, and fiduciaries all at the same time. So reach out today and we'll connect you with a local Householder Group office nearest. I want to thank you for joining us today, and hopefully you walked away with some valuable information. And I also hope that you join us again next quarter when we'll be discussing the mid-year market update. And remember to make sure that you subscribe to this podcast so you can receive new episodes right when they're released. You can subscribe by clicking on the subscribe button on whatever platform you use to join us today. Well, as always, if you're enjoying the podcast or if you have a topic you'd like us to review, let me know. Just send us an email at educatedinvestor@householdergroup.com. That's educatedinvestor@householdergroup.com. Now, if you found the material we spoke about today helpful, please tell a friend. And be sure to cover these items of interest with your financial advisor at your next scheduled review meeting. You can locate and contact the independent fiduciary and holistic Householder Group financial advisor nearest you at householdergroup.com. That's the website, householdergroup.com. Well, onward and upward. Thank you again for joining us. This is your host, Jerry Blakely. Until next time.
The opinions voiced on this show are for general information only and are not intended to provide specific advice or recommendations for any individual, nor intended to be a substitute for specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal.
Householder Group Estate and Retirement Specialists, LLC advisors are registered representatives with and securities offered through LPL Financial, member FINRA, SIPC, investment advice offered through Householder Group Estate and Retirement Specialists, LLC, a registered investment advisor, and separate entity from LPL Financial. The opinions voiced in this show, program, or podcast are for general information only and not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.